Concept behind cost of capital. The entire financial management. Cost of capital alone. Little formula oriented. Yes, of course, concept is there, but you have to remember the formulas also parallelly. Other topics are substantially stuffed with concept. Here, little leverage is there. You have to remember the formula also equivalently. Cost of capital. Name itself implies its character. You know, in basic concepts, there are two basic objects are there in the financial management. Leah, what are all they? Prem Kumar, tell me, what are all the two basic? Yes.
Sir, procurement of fund and effective utilization of funds.
Okay, procurement of fund and effective utilization of fund. Am I right? So kindly slap yourself quickly. This is a commonly committed mistake. That's the reason I asked the question. Two basic objects are different. Two basic aspects are different. In general, students used to interchange the answer. So you have to be very careful. Understood? Otherwise, double the normal loss. 6 mark or 5 mark also loss. Whatever the time you spend, that is also loss. Am I right or not? So objectives of financial management, profit and wealth maximization. Aspects of financial management, procurement of fund and effective utilization of fund. Understood, Kanagrijam? Now, aspects of financial management also called what? When yesterday we have discussed. Aspects of FM also called
Functions of financial management.
Functions of financial management.
Functions. Okay. Have you referred in the institute material or not? Have you referred ICA material? No time. Yeah. After exam you can come refer. Now, before you are going to procure the fund, first aspect you have to procure the fund. Before you are going to procure the fund, we have to analyze 3 characteristics. They are the very first topic. 3 characteristics. What are all the characteristics of source of fund? What all you have to consider?
Risk, cost,
Risk,
and control.
cost and control.
Yes.
High risk goes to which fund?
Borrowed funds.
Borrowed fund. High cost goes to which fund?
Owned funds.
Owned fund. High control goes to which fund?
Borrowed funds.
Borrowed fund. Okay.
Owned funds.
Yeah. Borrowed fund. So we have to see everything in company's point of view, not in the investor's point of view. Okay. We have to see everything in what? Company's point of view. Are with me or not? Now, with respect to the procurement of fund, effective utilization of fund, all those things. Cost, risk, cost and control we have come across. With respect to risk, cost and control, if you are going to see risk, cost and control, in cost of capital, we are going to discuss about cost aspects. That's why cost of capital comes into picture. Ilya? Cost aspects we are going to discuss now. Suppose you need money and you are going for loan வாங்கலான்னு போற. For Prem Kumar, 2 banks are ready to give for the loan. Okay, Kanna? First bank, they are ready to give the loan at 18% interest. Interest on loan comes to 18%. In second one, they are ready to give for 19%. Which bank will prefer, Kanna?
First bank.
18%.
First bank. Why?
Percentage is less. Interest is less.
Lesser interest rate.
Interest rate.
So, I want to procure the fund. I need fund. If I need fund, first I have to verify what? Cost of the fund. Am I right? Interest rate and pathaham. Are you with me or not? Based on cost only, I can be in the position to identify which fund is preferable. Are you able to follow? As usual, good response.
Yes, sir.
Okay.
Yes, sir.
So the fund, what is preferable, is purely based on what? Cost involved for the same. Based on cost only, I can identify whether company A is preferable or B is preferable and all. Or bank X is preferable or Y is preferable. It's purely based on cost. Where I am going to get less cost, that option is preferable. That's why before procurement of fund, we have to analyze the cost of the procurement. That's the reason if you are going to see the institute topic, it's a chapter itself. Cost of capital, thereafter capital structure, also called the capital structure theory will come. Cost தெரிஞ்சாதான் we can frame the capital structure. So cost is important. Thereafter you have to go for capital structure. Are you with me?
Yes, sir.
Comfortable?
Yes, sir.
Yes, sir.
You know procurement of fund. What are all the way in which they are going to procure the fund, Kanna? What are all the way in which they are going to procure the fund?
Own fund and borrow.
Own fund and borrowed fund. Under own fund, what are all there in own fund?
Equity and preference.
Equity share capital. Next, preference share capital. Next,
Retained earnings.
long-term retaining. Next, long-term loans and
Debentures.
debentures. These are all the various ways are there to procurement of fund. Am I right or not? These are all the various ways are there. Now, yes, sir, issuing shares, yes, Kanna. So these are all the various ways of procurement of fund. We have to identify, we have to analyze in this topic. The concept behind this topic is what? I am going to explain the concept only. Okay? The concept behind this topic is what? What are the cost involved for the purpose of this procurement? That is what you are going to learn. Are you with me? Cost involved for procurement. With respect to cost involved for procurement, cost nu paakonu illaya, how much the cost involved? How to identify? It's purely based on percentage. Cost of capital, you have to express in terms of percentage. Interest 1 lakh, 5 lakhs, 20,000, there is no meaning at all, am I right? You have to express in terms of 18%, 12%, 15%. Percentage. Therefore, the entire cost of capital, that cost of capital itself, you have to express in terms of percentage. Therefore, all the formula you have to multiply with what? To convert the percentage, you have to multiply with what? 100. So 100 all multiply. Now, you said various ways in which you have to procure. Nothing but source of procurement. With respect to source of procurement, every source, nobody is going to give the fund at a free of cost. Clear? We have to pay something in return. That is called the cost. Own fund means you have to pay dividend. Borrowed fund means you have to pay interest. Therefore, the coverage of topic is what? Own fund, borrowed fund, cost. Therefore, note it down. Cost of capital, kindly note it down. Cost of capital, it represents cost incurred for the purpose of procurement of fund. Cost incurred for the purpose of procurement of fund are known as cost of capital. Cost incurred for procurement of fund. Cost of capital has to be expressed in terms of percentage. Next point. Cost of capital has to be expressed in terms of percentage. Okay. Next. Coverage. Segregate into 3 parts. Coverage segregate into 3 parts. One is cost of debt fund. Cost of debt fund. Second one, cost of preference shares fund. Cost of preference shares fund. Next, cost of equity. Cost of equity. Are you with me? Then cover all the three: debt fund, preference share, equity. Cover all the three. That is called overall cost of capital. Combination of all is called overall cost of capital. Okay. So in this segment, our coverage is for debt fund cost we are going to compute separately. Equity fund cost we have to compute separately. Preference shares funds shares fund cost we have to compute separately. And company as a whole, debt fund, own fund, borrowed fund, combination of all will be there, right? And the total fund cost you have to compute separately. That is called overall cost. Are you with me?
Yes, sir.
About 4 different segments we have to discuss. What are the first one?
Cost of debt fund.
What you don't? Cost of debt.
Debt fund.
Yeah. First one, what you don't? Cost of debt fund. Before you are going to solve the problem, you should have the proper notes. Okay? Concept you should be thorough. Cost of debt fund. It represents cost incurred for the purpose of procurement of fund. Cost incurred for the purpose of procurement of fund by way of cost incurred for the purpose of procurement of fund by way of what?
Debentures.
Debentures slash loan. Debentures slash loan. Good. Kavita, noting down or not?
Yes, sir. Noting, sir.
Good. Here cost represent payment of interest. Cost represent payment of interest. Cost of debt is denoted by way of cost of debt is denoted by way of Girija, what?
KD.
KD, your name only, okay? KD. See, our name la vardu par. What Aishwarya Rai you know? Cost of debt is denoted by way of KD. What Kadambari? Sleepy mood? Like that. Then computation segregated into 2 parts. Computation segregated into 2 parts. One is irredeemable debt. Another one is redeemable debt. One is irredeemable debt, another one is redeemable debt. Under irredeemable debt, KD is equal to, don't write your name, okay? KD is equal to interest into 100 minus tax rate divided by NP. Interest into 100 minus tax rate divided by NP. Under redeemable debt, KD is equal to interest into 100 minus tax rate plus RV minus NP divided by N, RV minus NP divided by N whole divided by RV plus NP divided by 2. I'll repeat once again. In case of redeemable debt, interest into 100 minus tax rate plus RV minus NP divided by N whole divided by RV plus NP divided by 2, where RV represents redemption value. NP represents net profits of issue. Issue nala vara income, net income. N represents number of years. Okay. Next. In numerator you come across RV minus NP divided by N. Am I right? That is called average premium. Popularly called average premium. In denominator you come across RV plus NP divided by 2. That is called average liability. What is it called? Average liability. Like opening stock plus closing stock by 2 mari. Simple average. Average liability. Understood? Next point is supposed to remember. Note. Dear students, in examination, they won't specify. Okay? Anusha, this particular problem is based on redeemable debt or irredeemable debt. They won't give any information. Because depending upon redeemable or redeemable, formula also going to vary. Am I right? So how to identify? You should not choose the wrong formula. Am I right? Whenever year of redemption given in this question, you have to solve the problem by way of redeemable debt. Year of redemption is not given, then you have to use irredeemable debt. Note it down. If year of redemption, noted the code. If year of redemption is given in this question, we have to solve the problem by way of redeemable debt. Next, if year of redemption is not given, we have to solve it by way of irredeemable debt. Understood all of you? In examination, in question paper, they won't give any specific information. We have to identify based on available data. Accordingly, you have to write the formula also. Are you comfortable? Good. So with respect to coverage, 4 things I have told. First one is cost of debt. What is the second one?
Cost of preference share.
No, you don't. Second one, cost of preference share. The next concept, cost of preference share. It represents cost incurred for the purpose of procurement of fund. Cost incurred for the purpose of procurement of fund by way of preference share capital. Procurement of fund by way of preference share capital. Here cost represent payment of preference dividend. Cost represent payment of preference dividend. Cost of preference share is denoted by way of KP. Cost of preference share is denoted by way of KP. Okay, good. Computation segregated into two parts. Computation segregated into two parts. One is irredeemable, another one is redeemable. Irredeemable and redeemable. Under irredeemable, KP is equal to preference dividend divided by NP. Since you have to express in terms of percentage, you can multiply with 100 also. Okay, preference dividend divided by NP. Next, redeemable, KP is equal to preference dividend plus same formula RV minus NP divided by N whole divided by
Right.
RV plus NP divided by 2. Okay. Are you comfortable? Good. You know, three characteristics of source of fund: risk, cost, and control. Am I right? High cost goes to which fund? Same.
Own fund. Own fund.
Own fund. Very good. Janagi, can you please tell me why high cost goes to one fund? What is the reason? Very good response. Pooja. Vinita. Why high cost goes to one fund, Kana? Mr. Sonu.
So the dividend may vary.
Okay. Two main reasons I said. One is dividend expectation of the shareholders are always higher than interest expectation of the loan holder. The second one, what is the second important thing?
Tax shield will
Yes,
be
high
available.
interest. Yes, no, high interest not a correct answer.
Tax shield will be available.
Tax shield, Rakana. That is important. Clear? With respect to tax matter, am I right? So, tax possibly with respect to tax benefit will be there in which fund?
Borrowed fund.
Borrowed fund, not in the own fund. Am I right or not? Okay. So Santosh, listening or not? Tax benefit or tax shield is there in the borrowed fund. Tax benefit is there for the borrowed fund, not for the own fund. That's why if you are going to see the formula, previous one, debt fund formula, if you are going to see, interest into 100 minus tax rate. Am I right?
Yes.
Whereas here, preference dividend, KP, preference dividend divided by net process of issue as it is. There is no tax benefit at all. Am I right or not? Therefore, difference between KD and KP is what? The tax benefit only missing. Am I right? Now you got the idea? Otherwise, both are same only. Next. So here also, in examination, they won't specify whether redeemable or redeemable. Asif Ali, how to identify whether redeemable or redeemable? preference share is redeemable or redeemable? How to identify him?
Repayment
Santosh,
years will be given.
what kana?
Redeemed after so and so years.
Yeah, year of redemption given in this question means we have to solve the problem by way of redeemable, else it is called irredeemable. Accordingly, you have to solve the problem. Are you comfortable? Good, good, good. So, cost of debt over cost of preference shares over. Am I right? What is the next one? Next
So
concept
equity.
we are
Cost
discussing
of
about.
equity.
Yeah, third one is called cost of equity. Okay. Now, based on the concept only, all the problems are there. Refer ICA material or practice manual or past exam question suggestion answer, MTP, RTP, everything based on what? This particular concept only. Now, cost of equity. Note it down. Cost of equity. It represents cost incurred for the purpose of procurement of fund by way of cost incurred for the purpose of procurement of fund by way of equity share capital. Here cost represent payment of equity dividend. It is denoted by way of KE, denoted by way of KE. Computation segregate into 5 parts. Computation segregate into five parts. ஐஸ்வர்யா பயப்படாம எழுது 5 பாயிண்ட் அப்படிங்க பிரியதர்ஷினி எக்ஸ்பிரஸ் பண்ணல ஐஸ்வர்யா எக்ஸ்பிரஸ் பண்ணிட்டா அவ்வளோதான் பிரியதர்ஷினி எப்படி தானே segregate into 5 parts. One is income approach. Second one is dividend approach. Income approach, dividend approach. Next, growth approach. Growth. Next, realized yield approach. Realized yield approach. And last one is CAPM approach. CAPM approach. Okay. What does it? CAPM stands for what? Chartered Accountant, Prime Minister.
Capital asset pricing model.
Very good, very good. Priyadarshini always great. Prem Kumar also. CAPM stands for Capital Asset Pricing Model. Capital Asset Pricing Model. Understood? Formula note பண்ணிங்க. Income approach, formula for the income approach. KE is equal to EPS divided by MPS. Not EPS by OPS. Okay, EPS, earning per share divided by MPS, market price per share.
Per share.
Dividend approach, DPS divided by MPS, dividend per share divided by market price per share. DPS divided by MPS. Okay. Next. Growth approach, DPS divided by MPS, dividend per share divided by market price per share, plus G. DPS divided by MPS plus G. G common factor denominator. You should not put it in denominator. Okay. G for gold winner.
Percentage.
Growth. Girija will tell gold winner. What put must 3? Next, realized yield approach, same formula. DPS divided by MPS plus G. In realized yield approach, G growth represent past growth, already incurred growth. Whereas previous one growth represent future growth. That difference not required for intermediate level. Just you can remember the formula alone. Okay. And CAPM approach. Capital asset pricing model. KE is equal to RF plus beta into RF plus beta into RM minus RF. RF plus beta into RM minus RF. RF represent risk-free rate of return. RM represent market rate of return. And beta represent risk factor. RM minus RF is popularly called risk premium. RM blend RF kachitona, the balance is called what? Popularly called risk premium. Sometimes instead of giving RF, RM separately, they may give risk premium also. So it should be in the question to know how to manage. Okay. So easy way to understand. You are having fund, money you want to invest the fund. Okay. Ashna, can you please tell me? You want to invest the fund. Option A, post office, in savings you can invest. Option B, mutual fund. Which one is the safest one?
Mutual. Post office.
Anu, which one is the safest one?
Post office.
Postal is the safe one. Am I right? No other doubt. Where will get more return? Mutual funds or post office?
Mutual fund.
Mutual fund. Now you got the idea or not? Now, mutual fund, for example, okay, they are giving 10% return. Post office, they are giving only 4% return. Mutual fund is a market value, RF, okay, RM, okay, 10%. Whereas risk-free rate of return, without risk, you will get 4%. 10 minus 4 is equal to 6. Because of you are accepting risk, they are giving premium. Are you with me or not? Now ready to accept premium or risk accept. I am ready to invest the money in what mutual fund or private security. Then because I am accepting as an investor, I am accepting the risk, they are giving some extra premium. That's why it's called risk premium. RM minus RF is called risk premium. Now got the idea?
Yes, sir.
Yes, sir.
So without knowing this type of concept, mere solving the problem utter waste. There only keep on, they will give the twist. One examination they asked, RF they are given, beta was given, risk premium they are given. Student got confused what to do because they need RF, RM. Are you able to follow or not? RM minus RF, net answer was given. So if you don't know the concept, you can't the question to solve the problem itself. Are you able to follow or not? Clear? Similarly, once they are given the question, it's a small question, okay? They are given Post office savings, some amount. Private, some rate. And beta rate given. Student got confused what to do. Because they don't know what is called RF, what is called RM. They are not definition, they are not studied properly. They don't know how to solve the problem. Understand? So RF na risk free rate of return. Adu mattum podadhu. What is called risk free rate of return? Little concept. Innu periya nariya concept kathukala. Clear? Just kuti concept. What is relevant for the examination at least you are supposed to aware. Am I right or not? Now got the clarity?
Yes.
Okay?
Yes.
Now, what is the last one you have to discuss? Last concept? Overall. Because company's point of view, cost பார்க்கறோம் இல்லையா? Cost of the capital. Capital represent what? Equity share capital, preferred share capital, long term loan, debenture, combination of எல்லாம் இருக்கும் இல்லையா? அப்ப கம்பெனிக்கு total capital employed how much? Further, how much the cost incurred by the company? Own fund and borrowed fund, how much the cost incurred by the company is called overall cost of capital. Understood? Note it down. Overall cost of capital. It's popularly called WACC, weighted average cost of capital, WACC. Yes, Prem Kumar, I'll explain later. Okay, weighted average cost of capital. It represents overall cost incurred by the company for the purpose of total procurement of fund. By way of equity share capital, preference share capital, long term loan and debenture. So combination of all. Here cost represent payment of interest and payment of dividends. Payment of interest and payment of dividend. Weighted average cost of capital is denoted by way of WACC is denoted by way of KO. It's also called overall cost of capital, also called weighted average cost of capital. Okay, KO. Harsh Kotari, can you please tell me, lower the KO is preferable or higher the KO is preferable? Take your one time, tell tomorrow, okay? Rajastri, what is preferable? Yes, Muhammad. Lower the KO is preferable. Okay, overall cost should be minimum. Lower the weighted average cost of capital is preferable. Understand? Next point you have to remember. With respect to computation of WACC, there are two methods are there. There are two methods are available. Two methods are there. One is book value method. Another one is market value method. Book value method and market value method. So yesterday I given the homework also, right? What to study. Okay. In that what to study, cost of capital, this all you have discussed, right? What and all you have to study in that. Have you noted or not?
Sure.
Yes. So book value method and market value method. Next note. In market value method, dash is not applicable. Edu apply agadu. Edu varadu. Dash will not arise.
Retained earnings will not.
Very good. யார் சொன்னதுக்குன்னா? Who told? சொல்ல மாட்டியா? So cost of retained earning will not arise. In market value method, KR, cost of retained earning, will not arise. Okay, Prem Kumar. Next important point. In general, KR is equal to KE. That is cost of retained earning is equal to cost of equity. Okay? In general only. Nothing but KE compute பண்ணுவோம் இல்லையா? 16% is the KE, cost of equity. Same 16% you have to take for cost of retaining also in general. Next, however, most important point. However, if shareholders' personal tax is given in this question, kindly highlight most important point. If shareholders' personal tax is given in this question, then KR is equal to KE into 100 minus the personal tax rate. KR is equal to KE into 100 minus personal tax rate. Can you put a star mark in that? Important point. Okay. Next. Another commonly committed mistake is DPS to be MPS plus growth per only in KE computation. DPS to be MPS plus G. You may have come across, you may have the doubt also. Few problem DPS plus growth to by MPS plus growth போட்டிருப்போம். Few problems DPS to by MPS plus growth எடுத்திருப்போம். You will got confused, right? One problem growth double time வந்திருக்கு, another problem only one time. How many of you got this confusion? எல்லா பசங்களுக்கும் என்ன ஆகும்னா கன்ஃபியூஷன் வரும், அது அப்படியே வேனிஷ் ஆகும். We won't go to the next step to understand or you won't get the clarification. Again the doubt will come only in example. Right or not? The specialty of the CA examination is what and all we skipped that only will come for the exam. Right? What and all you omitted இந்த கான்செப்ட் வேணான்னு நினச்சி போவோம், அது வந்து தொலையும் இல்லையா? என்னைக்கு நம்ம இந்த ஒரு டைம் தான் ஸ்டாண்டர்ட் காஸ்டிங் படிக்காமல் போயிருப்பேன், that time only the standard costing will come. So which area you skipped, that area only will come. Am I right or not? That is what our fate, no? Clear? So you should not leave any concept. That's why concept is important. So few problem DPS plus growth divided by MPS plus growth வந்திருக்கும். Numeratorly growth add பண்ணிருக்கோம். So when? Any idea? Listen here. Whenever DPS for the last year given in this question, then for the purpose of KE computation, numerator DPS is equal to DPS plus growth. Last year DPS plus growth divided by MPS and common factor add growth. Are you able to follow or not? Whenever DPS for the current period itself given means normal formula DPS plus MPS plus growth. Are you able to follow? So these are all the things you should be very careful. That's all the area we'll use to commit the mistake. Are you with me? That's the reason we have spent this much time for the purpose of learning the concept. So I'll sum up what and all you have learned with respect to cost of capital. Mere solving the problem at our base without knowing the concept. Solving the problem very easy. For max only. So how to derive the formula, what is the concept behind the formula, that and all more important. So till now we have discussed with respect to cost of capital, Cost incurred for the purpose of procurement of the capital is called the cost of capital. Here, lower the cost of capital is always preferable. With respect to cost of capital, the coverage should be what? Cost of debt fund, cost of preference share fund, cost of equity fund, and overall cost of capital. That is called weighted average cost of capital. Any doubt? All are happy?
No, sir.
Yes, sir.
Conceptually happy, Kanna?
Yes, sir.
Good.